All right, everyone. Today we're going to talk about the difference between conventional versus non-conventional loans. Now, you may have heard this put as conforming versus non-conforming loans as well, but these two terms are synonymous with each other. So first, conventional mortgage. Conventional mortgage are the most common type of loan, accounting for about 60% of all mortgage applications. As private sector loans that are not government-backed but follow guidelines set by Fannie Mae and Freddie Mac, right? There's no guarantee to the lender if a borrower defaults, and thus requirements are known to be stricter, okay? But at the time with these stricter guidelines, you can also get better deals. So in general, a conventional mortgage is ideal for borrowers with good credit that can provide a larger down payment. Conventional loans are more affordable in the long run and can be a smart investment in the future. There are two types of conventional mortgages. These are fixed rate and adjustable rate. So some difference between the two. So fixed rate mortgages, right? They maintain a fixed interest rate over the life of the loan. This mortgage option offers predictable payments and is ideal for borrowers that intend to pay their home or stay in their home for a long time, right? And this is what I always suggest, fixed rate. We want to de-risk deals and we want to make sure that you are in a position for success, and change can really throw that off, right? Now with fixed rate, borrowers can choose between 15-year, 20-year, 30-year mortgages, and now there's even 40-year products out there. Now just note that the longer the loan term, the higher the rate. And so the shorter the loan term, the lower the rate. So the difference between a 15-year fix and a 30-year fix is a lower interest rate, thus causing not a lower payment because of the compressed time frame, but a lot less being paid to interest. Now, adjustable rate mortgages. We're still talking about inside of conforming loan modules. These are known as variable rate or tracker mortgages. An adjustable rate mortgage is a mortgage with a convertible interest rate. This mortgage option will allow the buyer to start out with a lower monthly payment. However, after an initial fixed period of 3 to 10 years, that rate can be adjusted yearly based on the performance of an index. Note that the rate caps will prevent the interest rate from going up or down past a certain point. And that is a very important question you need to ask your loan broker. Now, another thing that you want to understand is the reamortization. With an adjustable rate mortgage, when you chunk big chunks of money, or any money for that purpose, for that fact, on adjustable rate mortgage, it can readjust and it will reamortize based off of the new balance. Okay, so that's really important. It readjusts during those adjustment periods. So it'll reamortize during the adjustment periods. Where this gets very sticky is right now. People should not be getting into adjustable rate mortgages because we are staying higher for longer, and quite possibly will more than likely see higher interest rates going on in the future because of bank risks, instability in our government, inflation, all kinds of different things. So unless you have really good inside information or the understanding based off of what I teach in real estate cycles in that course about when the Fed starts really aggressively dropping rates, that's during a hard time. And so that would be the only time I would suggest doing it. But honestly, I've never had an adjustable rate mortgage unless I got it very inexpensive for one of my flip properties. So that's the only time I ever do it. Now let's move on to non-conventional mortgages. These are mortgages that are designed to help individuals with low to moderate incomes or individuals that require a low or no down payment, okay? So you can already see where this is going. It's gonna cost more. But if that's the barrier to entry, then blast through it, because the more important thing is if you can afford and you want to buy a house and it's going to give you stability in your life and thus give you the option of being able to write off mortgage, interest, all kinds of other options out there to be able to bring in wealth. If you're paying less for the payment than you are in rent, you should totally use this, okay? So just because you don't qualify for a conventional mortgage doesn't mean you shouldn't look into non-conventional mortgages, pay a little bit more, right? Maybe in fees, maybe in a rate, then get in for 6 months, prove yourself to be a worthy borrower, a worthy risk that banks took a risk on you and it paid off, and then go refinance into that conventional mortgage, okay? So this type of loan caters to borrowers, like I said, who have been rejected for a conventional loan. Reasons a borrower may have been rejected could include a handful of things, right? Like being self-employed, unsteady employment history, right? History of bankruptcy, insufficient cash reserves. These are the types of things that banks would look at and go, ooh, there's risk there, okay? So let's talk about some downsides. One downside to a non-conventional loan is they'll require the borrower to pay additional fees, right? Like mortgage insurance or MIP or PMI. But the thing is, when you look into that, the PMI has gotten so advanced now to where PMI is so much less expensive based off your credit score, your individual information. It's a lot cheaper than in the early 2000s when I started picking up a lot of mortgages and flipping homes and buying, rentals. So then there's also funding and guarantee fees, okay? So on top of that, so you got to look at all of that. Okay, so I totally had to open up my laptop and get you the most accurate data for a type of loan we're going to talk about next under non-conforming loans. These are jumbo loans. Well, the reason why I had to get the most recent data is because they change all the time. Because as we just saw interest rates kick up, and we saw the FOMO into the real estate market and the real estate prices go up, it went way past what the old jumbo limit or the conforming limit for mortgages were. So it says here in 2024, Fannie Mae increased its limits for conforming loans. In 2024, the new loan limit for most of the country will be around $766,550. This is a 5.5% increase over the 2023 limit. This is important to know because up until that point, you can qualify for a conforming loan. But if you go over that, you now go into non-conforming loans and what is called as a jumbo loan, okay? So non-conforming loans, again, they exceed the FHFA's limits, conventional mortgage financing limits. They generally have higher interest rates and higher down payments than conforming loans. In addition to conforming and non-conforming loans, there are existing programs such as Home Ready and Home Possible by Fannie Mae and Freddie Mac that are also many conventional loan options, or these are many of the different types of conventional loan options that are specific to each state. So you need to be sure to ask your realtor, your mortgage broker about any additional options that exist where you are looking to buy. So in closing, the difference between conventional and non-conventional is your personal situation. What is your current credit score, your work history, and your credit history? The credit score is one thing, but how thick is your binder? How much have you purchased in the past? What kind of loan companies or banks took you on as a risk, and how did you treat that, right? It's all about that, but then you couple it with the amount of the home and where the home is located. If you can qualify for a conventional loan, by far, it's going to be the best option. If you can't, I'm not telling you not to buy the home. I'm saying look at how much it's going to cost you. Does it still make sense? Does the deal still make sense? If it does, get into it and then build that credit, build that payment history, and then refinance later into that conforming loan. Conforming loans are going to have less fees associated with them and lower interest rates. They are an amazing opportunity. So check that out. I hope you got something out of this. Let's move on to the next lesson.